Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. I'm Michael Bull. Thanks for being with us. Today we're going to talk about retail and retail real estate. You know, retail has been the most volatile sector in commercial real estate. Well, with that volatility, that brings challenges and that brings opportunities. We'll look at both today. Please welcome my first guest, Ryan Severino. He's the senior economist with REIS. Ryan, thanks for joining us today.
Hey, Michael, good to be with you again.
Well, Ryan, thank you. And as I mentioned, retail has been volatile, but it's been improving, hasn't it? What did you see for property fundamentals throughout the country in 2014? Did you see some improvement?
You know, overall, it was really a mixed bag depending upon retail subtype. Neighborhood and community centers are still having a bit of a rough go of things out there. Vacancy declined during the year by about 20 basis points. However, asking rents actually grew by about 1.8%, which was just about on par with inflation. And that was the best year for rent growth since 2007, before the recession. So, things are getting better, just maybe not at the pace I think that a lot of people would like to see. And then for regional malls, vacancy actually increased by 10 basis points. Now, that increase was largely due to the closing of a number of Sears stores around the country. But that said, malls have clearly lost some momentum over the last year as high-end dominant malls, which were the ones that have been leading the charge for the recovery, they're pretty much full up at this point. So it's going to be the responsibility of those somewhat inferior kind of Class B and lower caliber malls to mount the rest of the recovery going forward if that overall sector is going to continue to improve.
I see. So what do you expect as far as the winners for retail property type? Is it these grocery-anchored centers? Is it these urban centers? What centers are going to benefit the most from our improving economy?
It really is a case of the haves and have-nots. So I would say if you're a defensive grocery-anchored center, especially in a good infill location, especially on the coastal markets, those centers should be just fine. If you're talking about the high-end Class A dominant malls, Tyson's Corner in Northern Virginia or something like that, those centers should be just fine. I think the centers that are going to struggle are going to be the ones that have some kind of deficiency. If you're a non-anchored neighborhood community center, that's going to be an issue going forward. If you are kind of a B-plus or lower caliber mall, but still kind of searching for demand to come back, even though the economy's been recovering for 5.5 years, those centers will probably continue to struggle a little bit depending upon the individual center. So it is definitely a multi-speed recovery right now.
Okay. And Ryan, what are some of the factors that are impacting the recovery in retail? I know the drop in gas prices seems to be helping everyone, and people are doing a little more spending in retail, aren't they?
You just about read my mind. So while there are some key trends that are occurring right now, I would say the one that I would really focus on has been the massive decline in energy prices. When energy prices are in decline and it's actually sustained, which they clearly are at this juncture, it boosts consumer spending. And typically this occurs about 6 months after the decline begins because it takes a little while for consumers to believe that these declines are durable and then consequently adjust their behavior. So the back of the envelope rule is something like a 10-cent sustained decline in the price of a gallon of gasoline causes consumer spending to go up by about $13 billion. So if we examine the decline in gasoline between last summer, when according to AAA it peaked at about $3.69 per gallon, to where we were the last time they did a measurement, which was about $2.13 per gallon, and then use that 10-cent rule of thumb, it translates into about $200 billion of extra consumer spending that we wouldn't have had. And that should be a huge boost for retail, certainly an unexpected boost, because it's basically like a tax abatement, because whether gasoline costs $4 a gallon or $2 a gallon, your car is going to run the same way. So you don't derive any extra benefit from the increased cost of gasoline. It basically serves as a glorified tax. So this is like a huge tax abatement for 100 or so million households in the United States.
And from what you're saying, since there's a 6-month lag, then it's basically the improvements for retail because of the lower gas prices is basically just getting started?
Right, that's exactly right. We should really see this materialize to a greater extent over the next 6 months, because not that there isn't a relationship between declining gas prices and spending on a sort of real-time basis, but it does take a while for consumers to believe in the declines becoming more durable and then adjust their behavior. So we see a stronger negative relationship, meaning gas prices fall and spending goes up if you lag the data about 6 months. So we should really see this start to have an impact on consumer spending over the next 6 months or so.
Okay. And one of the things that I find very interesting about the commercial real estate industry are construction levels. It seems like the lack of new construction has really helped the commercial real estate property fundamentals and the investment sales. But, retail looks like it's a little bit of a mixed bag from what you're saying. So what are you seeing for new construction levels, and how do those levels compare to the past?
We are still not seeing much in the way of new construction. For 2013, for neighborhood and community centers, there were only about 7 million or so square feet that were delivered in 2014. That's just about on par with what we've seen over the last few years. On the mall side, we still see virtually no new malls being built from the ground up. Now, certainly there are some additions to malls that are scattered around the country, but in aggregate, that doesn't add up to that much inventory relative to the size of the existing footprint of malls. So I would say the construction environment is still relatively benign, not that it's not going to impact individual centers on a property-by-property basis, but in aggregate, I would say there's no real systematic impact from construction at this point.
Okay. Well, what does all this mean for 2015, Ryan? Look into your crystal ball and tell us, what do you think we're going to see moving forward?
For neighborhood and community centers, I'd say to probably expect vacancies to fall maybe by about 0.5%, 40 to 50 basis points this year, which is a bit of an acceleration versus the last 2 years. For rent growth, we expect asking rents to grow by roughly 2.5% or so, which would honestly be the best performance since before the recession, and it would actually be in excess of inflation, which would be the first time since the recovery took hold a few years ago that we would see rents growing in excess of inflation. For malls, it is certainly going to be an interesting year because with vacancy having bottomed out for those Class A malls, like I mentioned, any improvement in vacancy is going to have to come from inferior malls, and they're still grappling with ongoing store closures. Retailers like JCPenney, Wet Seal, Macy's, and Izod, just to name a few, have announced store closings fairly recently. So it could be another challenging year for the malls because it is going to be those kind of lower caliber malls that have to pick up the slack. Now, that said, the tightness in those Class A malls is going to translate into more meaningful rent growth because the landlords still have the pricing power in those markets. So I would expect more robust rent growth for the sector overall this year. But on the vacancy side, it's really going to be left to those B-plus and lower caliber malls to really pick up the slack if we're going to see any improvement in vacancy this year.
We're talking with Ryan Severino. He's senior economist with REIS about retail and retail real estate. And Ryan, moving forward, what are some of the factors that could negatively affect retail?
The one that I key in on is really weak wage growth. I think there's been a lot made in the press about how there has been this kind of rift between have and have-not households and how most of the benefits of the economic recovery have accrued to a relatively small percentage of the population. I think that is certainly true. I think what could help spending going forward and impact the retail center would be if we got stronger wage growth. Wage growth right now is basically trending around inflation. So the majority of households in the economy are basically just treading water, keeping pace with the increase in prices over time. And it's certainly been holding back discretionary spending on the part of many households. I think that's really reflected in the performance at the individual retail center level, where the top-end centers, those Class A dominant malls, have been scorching lately, whereas the majority of malls have still been struggling. The good news is most economists expect this to accelerate over the next couple of years. We've gotten much better performance out of the labor market in terms of the numbers of jobs being created. The caliber of jobs that are being created is better than we've seen in the past. So I think most rational people expect this to accelerate in the coming years. But that said, if for some reason it doesn't, that's going to continue to hold retail spending back because, as you can imagine, if most households are just keeping pace with inflation, it's somewhat challenging for them to go out and spend in a discretionary manner. And that is the kind of spending that can move the needle on demand for retail space. When consumers finally move past just spending money on necessity items and then move into spending on more discretionary items.
Right. Yeah, that makes sense. That's interesting. And we're going to take a short break here. When we get back, we're going to talk to Ryan about the investment market. We're going to look at cap rates. We're going to sales volume, and what all this volatility means for the investment market, and also talk about some possible opportunities. Keep in mind, we have some fantastic shows coming up on the schedule this year, and you can check out those shows on the show website, CREshow.com. Just hit the tab Next. You can also sign up for a once-a-week email announcing the show topic at CREshow.com. Well, stay tuned. We'll have more on retail and retail real estate next with Ryan Severino. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.